Welcome to today's webinar hosted by Rockall Technologies, How to Use Collateral Tracking to Grow Your Loan Book. We will be recording the webinar and all attendees will be sent a link to the recording. At the end of the webinar there will be a question and answer session. You can send your questions to our speakers by using the questions box in the GoToWebinar panel. Our first speaker today is Mark Simons. Mr. Simons is the Director of Sales at Rockall Technologies. Following Mr. Simons will be Luke Nestor. Mr. Nestor is the founder and CEO of Rockall Technologies. I'm now going to hand things over to Mr. Simons.
Thank you, Mike. Good morning, everybody, and good afternoon to people in Europe. Thank you for joining our call. I just want to briefly introduce today's agenda. The title of our webinar is How to Use Collateral Tracking to Grow Your Loan Book. This is the second in a series of webinars which we'll host over the coming months. I think we are planning one more webinar before the end of the year, and that will be on managing facilities and limits in corporate lending. Before we start, I just want to be clear to the audience that the specific topic today is wealth management, and in particular non-purpose lending backed by liquid collateral. By liquid collateral, we're referring mainly to marketable securities, deposit accounts, and covenants. If we just look at the agenda, bring up that slide. The agenda we're going to follow today is that, first of all, I'll give a brief introduction to Rockall for those of you who are not familiar with us, and then I will hand over to our main speaker, Luke Nestor, who's the CEO of Rockall Technologies. Luke will talk about some of the challenges that we see people facing in wealth management and private banking in relation to how they manage their collateral and their collateral operations. We are proposing an approach to solve these challenges. We recommend a unified approach to collateral management where we take the view that collateral is essentially a first-class citizen of the enterprise. Luke is going to talk about what that means in terms of how banks organize themselves and in terms of the impact it has on IT from a systems perspective and from an operations perspective. Then we'll drill down into some of the detail around the specific tasks involved in collateral management and how they can be best organized, and we'll assess the impact that these can have on operations. We'll discuss how this approach helps banks to scale their operations and in particular to grow their loan books. Luke will talk us through some of the benefits that we see banks deriving from this approach, not just in terms of having the ability to scale their operations, but in other areas like client retention and loss reduction. Luke will also talk about some trends that we are seeing in the market in terms of what the large banks are doing, perhaps even what some of your competitors are doing. Then we'll talk briefly about a hypothetical case study where we'll look at the challenges that we've seen customers face and how they've addressed those challenges. Hopefully that will resonate with some of the people on the call. During the call you'll have an opportunity to send us some questions, and we encourage you to do so. As Mike said earlier, there should be a control panel that you can see on the right-hand side of your screen with a question box. You can type your questions into that box, and at the end of the meeting we will address those questions. In terms of timing, we've allocated an hour for the meeting, but we expect to get done through the agenda in about 30 or 40 minutes. And the audience are all on mute, so those of you working from home can relax about any background noises. Rockall at a glance. With the preliminaries out of the way, I'd like to give a brief introduction to Rockall for those of you who are not familiar with us. We are an Irish company, as you can probably tell by the accents you'll hear on the call today. We are headquartered in Dublin, Ireland. The company was founded in 2001, and our exclusive focus is to provide software solutions for collateral tracking. Our flagship product is called STOC, S-T-O-C, which stands for Systematic Tracking of Collateral. This is a market leader in our space. We also have offices in Charlotte in the US, where I'm based, and we have an office in the Middle East. Our client base is global. We have clients all over the world, in the US and in EMEA. We have as clients Wells Fargo, US Bank, Barclays, and many more. We are honored to serve dozens of customers, including 4 of the top 10 banks operating in the US today. Our clients operate in multiple collateral disciplines, including commercial lending, where the collateral at play would be real estate and equipment, wealth management, which we'll talk about today, where we're dealing with liquid collateral, deposits, trust accounts, brokerage accounts, etc. And we also have customers in the corporate lending space, and they are interested in managing facilities and limits for related entities, and they're lending typically against inventories and receivables, traded goods, for example. In terms of footprint within banks, we have installations in the wealth management space which range from just a small number of loans under management to tens of thousands of loans, and then a multiple of those in terms of collateral items. I'd encourage you to go to our website for more information. It's www.rockalltech.com. Also, if you have any questions, my contact details will be shown on the last slide of the presentation. And as Mike said, we're recording the webinar, and all of you will be sent a link to that recording. If we just jump to our next slide, we have our tagline here, which is that every day over $1 trillion of collateral are processed through stock on a daily basis across our client base. And I'd like now to introduce our featured speaker, who's Luke Nestor. So Luke is the founder and Chief Executive Officer of Rockall Technologies. He has 25 years experience in designing and delivering collateral management systems. Luke founded Rockall in 2001 to provide the financial services industry with a fully modern, standalone, enterprise-class system for collateral management. Luke Nestor leads overall product strategy at the company, and he is passionate about the use of collateral management systems to maximize lending potential, control risk, and grow loan book. I hope that we will hear some of that passion from Luke today. Luke?
Thank you, Mike. Thank you, Mark. Good afternoon to everyone on the call. What I'm now going to discuss is going through a number of slides. I'm going to discuss the before and after picture of how a bank might exist today and how it might look in the future. I'm going to discuss the complete solution or the complete capability that one might apply if it were to approach collateral management from this perspective. I'm going to discuss the benefits of the solution from a user and a business perspective. I'll be discussing how you'd go about making the case for implementing such a solution or such an approach, and discussing some trends that we're seeing in the market, and then finally briefly going through a case study where we'll illustrate what the challenges of a particular organization were and basically how those problems have been solved. So the before picture, or the collateral management challenges. What you're seeing here is basically a series of systems which are unconnected really to any great degree, and this might be okay for a very small organization with a very small number of non-purpose loans. Just to be clear about the terminology, when we use the word non-purpose loans, we mean effectively loans that are secured by liquid collateral, that's marketable securities and cash. Non-purpose loans are, across the banking system in the world, vary from very small books to very large books. We deal with clients who have somewhere between a small number and a large number. But if an organization has no ambition to change the way it does business in relation to the number of non-purpose loans it takes on, then maybe the systems that they have at play at the moment, like using Excel or taking feeds or going to Bloomberg to get pricing, a very manual process, might be okay if your number of loans are small. However, we're addressing here where an organization wants to grow its loan book and how it might do that, as well as an organization that may have a significant loan book already of non-purpose loans and wants to look to see how it can manage it more efficiently. So this diagram is the typical before situation, where you have not approached this from a unified collateral perspective or a unilateral collateral perspective. As you see, multiple disparate systems all kind of connect to each other, but mainly through human endeavor. So the unified approach to collateral and management of non-purpose loans, really it's bringing together customer loans and collateral into one place through fully automated and integration capabilities. What it can do for you once you can bring this data together is a fully automated capability whereby you can manage customer position, you can automatically make margin calls, either through human endeavor by the system prompting a human to make contact with the customer, or even directly. And our clients vary from one to another. Some would like to be prompted so they can make an interactive personal call, where others will issue directly an email to the client outlining the position. Other features that would be managed through a total solution would be regulations and communications. the whole principle of this is management by exception rather than having to manually go through each case to establish the position to see if a margin call or an activity needs to take place. What we promote, and we would advise any organization to do in a fully automated world, would be to allow this to occur on an exception basis, i.e. only react to cases that are nearing out of margin or are actually out of margin, only react to cases where there's Reg U or Reg 23AB issues, etc. The only time you would proactively go to the system for management to be on a review basis, whereby on an annual basis you might want to review your customer relationship, and we can support that feature as well. So the typical after picture, this is really where you've brought it all together. You're taking feeds from the various sources of data. Typically the customer would have some connection to trust or brokerage data, and I'll touch on external brokerage a little bit later, but right now this is addressing where you're getting feeds from trust or brokerage systems and deposit systems, you're getting feeds from loan systems, and you're getting feeds from external sources if you can't get pricing from a source like the trust or brokerage system. So this sort of brings it together in one place. So now to get into a little bit more detail, this is a very busy slide, and I'm going to touch on some of the subjects that are covered here. The key to non-purpose lending, as I said, is bringing customer exposure and collateral data together. So you can track on an automatic basis margin positions or client positions. And it supports, I'll touch on triage a little bit later on in this slide, but it supports, first of all, the setting up of cases. You can set up your bank policy from an eligibility perspective, whereby you can define what is acceptable from an eligible securities perspective. So you can define what you want as eligible securities, because portfolios can contain eligible and ineligible from a non-purpose loan perspective. You can define your advance rates or your haircuts at very fine-grained level to allow you control how you might value a security from a margin perspective. In other words, you will apply haircuts to various asset types. And this is a very fine-grained mechanism, and any organization that's involved heavily in this business should deploy such a fine-grained mechanism. Included in that is the ratings of, say, bonds, etc., where you would look at the rating of a bond, and it would be a different haircut can apply based on the rating. The key to the system is monitoring, and that's basically measuring your loan-to-value in effect. Measuring if a case is out of margin, i.e. the value of the collateral after haircut or discount is not covering the exposure. And the important thing to do is to ensure that you are on top of what we call margin calls immediately, and not on a monthly basis or a weekly basis, but on a daily basis, so that you can make contact with your client. Very importantly, explain the full situation, because a good unified system and approach to this will allow you to have the information to inform your client of why they're out of margin, exactly what's occurred, maybe how many times they've been out of margin before. And as we all know, good communication with a client, especially in difficult situations, is very important. And what I mean by good communication is having all the information that's required at your fingertips. This can equally be done through correspondence, because a good system in an automated fashion will allow you to generate the correspondence via email or by standard mail automatically, so that there's no human involvement in the activity. Obviously, pricing is critical to this, and as I said earlier, if your pricing can come from your brokerage or your trust account sources, you can get it from there. But if you're using, say, external data or external brokerage, you might need to go to some market vendors like Bloomberg, Reuters, IDC, etc., to actually get up-to-date pricing, so you can calculate your actual collateral value. Another aspect of monitoring is you may have a client who's bordering on margin on a frequent basis, and in that case you can set up and should set up watch lists. So as the client nears a margin position or an out of margin position, you can track that as well and ensure that you keep a close eye on aspects there. The regulatory aspects of this world are Regulation U, whereby you're looking at margin loans, or Regulation W, whereby you're looking at loans made to directors, or where loans involve stock of your organization, and they have to be treated in a different way. The last piece of regulation, and there's lots more regulations involved across the world, but in the US, supervise the LTV, which is basically reporting on LTV values. What we found across the client base that do this type of lending to date is that quite often they actually treat these as non-secured loans, and therefore they don't have basically a high loss given default or LGD, or a low LGD. In other words, if you do this properly and do it through a fully automated system where securities are as close to cash as you can get the highest value allowance for the collateral against these loans. As I said earlier, another aspect of a good system will allow you to review your cases on an annual basis. And one of our clients, for example, it used to take them nearly a day to do a full review of clients who have these type of non-purpose loans. Now it's taken them 10, 15 minutes through a full unified collateral system. So to move on to some of the benefits and some of the challenges before and the benefits after. The most important one is if you don't have a system at play, or you have unconnected systems, you have a highly manually intensive effort to, first of all, to establish positions, secondly, to actually make calls, thirdly, to apply different rates, different advance rates or haircuts to get pricing, etc. And which obviously is a high overhead. So if you have a large loan book, or your loan book is growing, or you have a small book and you want it to grow, there's a very manually intensive effort involved here. With an after position, with a fully automated unified collateral system, this is all automated, and in real time you calculate positions. One key aspect of full automation is you're managing cross-collateralization, which is quite prevalent in the wealth management / commercial lending world, whereby collateral, one piece of collateral or one portfolio can secure multiple loans. The important aspect here is to ensure that you don't inadvertently release collateral that's securing another loan, basically. The before situation, as you can see here, is no history of tracking. So you can't really see when was the last time we made a margin call to this client, what were the circumstances, how long did it take to resolve, etc., etc. Inconsistent communication with the customer is extremely important that you get that right, that when you contact the customer again in these different circumstances, you have the information at your fingertips. One of the critical aspects of having a solution like this is to ensure that if there is a significant market dip, which we all know there has been over the last few years, particularly 2007, 2008, that chaos can ensue if you don't have a decent system. A number of our clients have been through this in multiple ways, before and after. One client in previous times had a very significant loan book, and it was before they implemented our system, and there was absolute chaos in terms of trying to track the overall situation. Since our system, their losses were very, very small. Of course, there's going to be losses if the portfolios decrease significantly in value, but their ability to react to the market problems was highly efficient. A good solution will provide triage. In other words, you will be able to identify which are the highest risk cases that you need to identify first, and a good system will allow you to monitor that, to ensure that you resolve the higher risk items first. That could be high risk in your client or high risk in the value. So this system or a good solution in this world will ensure that you can deal with significant market dips. So loan book growth, which is a key subject here, is how do you grow your loan book by using a system like this? Well, first and foremost, you can proactively go about selling loans in this space. A number of people and organizations we've met over the years have said they reluctantly do these loans, and they have to treat them as non-secured loans. Through providing and implementing a unified collateral system, you can, first of all, get the maximum benefit from a collateral perspective. You can lend proactively on a low-risk basis. for example, one of our clients is now seriously leveraging their brokerage systems to proactively sell non-purpose loans, which means that in the past they kind of waited for clients to come looking for loans backed by securities or portfolios. Now they're proactively selling loans backed by portfolios. Because in the world we live in today, a lot of individuals or companies have portfolios that are sitting there in some situations they're looking to sell those portfolios to raise capital, whereas if you can offer a low risk system which uses these portfolios as collateral to loans, you retain your customer both from a brokerage point of view and potentially from a retail banking perspective. So the key is to ensure that you retain customers and don't see them selling portfolios to raise capital. The other aspect is you can, again with the unified and a good system, you can actually qualify loans, so you can proactively contact your customer base and let them know what value they have in their portfolios from a loan perspective. So through the haircutting, the advance rate rules, you can proactively inform clients what value could be used against a loan in this particular area. Obviously, as books grow in this space, you need significant management oversight and obviously significant risk. It is a complex enough area, and without a good system, your ability to grow is very limited. With a good system, you can grow significantly. One of our clients has had double-digit growth for the last 5 years throughout the whole turmoil and the whole market instances. So business benefits. One is obviously to grow your loan book. As I mentioned, marketable securities are liquid and they can move from brokerage to brokerage, and if they do, you potentially lose that customer. So through being able to promote a capability like this and to proactively offer customers the ability to borrow back to their securities, borrow back on their securities, you can ensure that you retain customers. The reduction of losses. Obviously, without a quality tracking system, you're exposed to losses. You're exposed to not being able to react quick enough to a situation. In this, with a quality system, you can be first there to deal with potential loss. You also reduce loan loss provision, as mentioned earlier on. You reduce the amount of provision you need to do. You have a reduced LGD, which means you increase your capability and ensures that you can maximize the collateral value from a capital adequacy perspective. And finally, I suppose it's reducing reputational risk to ensure that you're continuing to keep on top of your client base, to ensure that you can proactively let your client know what's happening basically in the market. So some market trends. The inherent value of stocks has remained pretty consistent for the last few years. Yes, there was a major dip in 2009, but the last maybe 12, 18 months, the Dow Jones has remained over 10,000. So this means there's inherent value in portfolios. And as we said earlier, a number of organizations that we're talking to and existing clients are actively and proactively looking to book loans or sell loans through non-purpose lending by leveraging off the brokerage accounts and the portfolio accounts. As mentioned earlier, customer retention to ensure that you don't lose if a client needs to sell stocks, but you suggest loan rather than sale of stock. So there is, from a trend perspective, a very active movement in increasing non-purpose loans. And with the mortgage market and the housing market down, and the organizations are looking for other ways of increasing their loan book. Clearly this leads to building a business case. And obviously the cost of doing this will be the one-time cost of installing a system or building the capability. The ongoing costs are obviously personnel to manage in IT, but the benefits are clear. Obviously, increased loans is increased margin. If you rapidly increase your loan book or your loan book increases, you don't need to increase your personnel. in accordance with that growth. So you can manage a very highly efficient growth. Your reduced capital needs, because you're now using the collateral instead of treating this as unsecured lending. As mentioned, reduction of resources and opportunity cost, which is the opportunity to sell these loans because you feel very safe in promoting these loans as a capability. So, as discussed earlier, we said we'd talk about a case study. One organization that we were dealing with, and the volume of loans was quite significant in this space. There was a lack of control. There was chaos during the market dip. There was this is prior to implementation of the system. There was significant challenges in meeting regulatory reporting and requirements. There was audit issues. Systems were obviously very manual, and even though they were very active in selling these type of loans, it was considered very high risk. So they needed to bring together a solution, to put together a solution which allowed for all the things I've mentioned so far. And the approach was obviously to do this, which meant bringing together the customer, the exposure, and the collateral systems. And when I say collateral, I mean the brokerage or the trust data, or external data, whereby a good system will facilitate the recording of a brokerage statement and at least being able to value existing CUSIPs or securities on a daily basis. Of course, if you don't have full control of an external account, you don't know what the movement is, but at least on a monthly basis, in an automated fashion, when you receive the latest statement, you can just compare existing CUSIP lists with the new CUSIP list and verify no change, and obviously in the meantime you've priced on a daily basis. So it's significantly better, but not 100% as one would like it, because you don't have necessarily electronic access to external brokerage data. But largely speaking, the experience of this customer, as I said earlier, was double-digit growth, managing the chaotic situation when there was a significant market dip, being able to triage, being able to be on top of high-risk cases early, automatic now reporting, regulatory reporting, improved customer experience by having information available to the customer at the time of a margin call, etc. And then basically by continuing this growth, they did not need to increase staff or people or processes so they were highly efficient and making most of the loan margin. So with that, I would like to pass back to the audience if you have any questions that you'd like to ask. We will just pause for a couple of minutes to see has anybody logged any questions. Okay, so looking at a few questions that come up, one has been touched on already, which is what about external brokerage? And basically, in that situation, as I mentioned, the system accommodates the recording of a statement and then the ongoing valuation throughout the month of that, on the grounds that the securities haven't changed. If they have, there could be a reconciliation the next month to see the movement, etc. Another question is asked, how long would it take to implement a system like this? And this is entirely dependent on the number of systems you have at play. If you have a straightforward single loan system and a single securities or brokerage or trust system, such as maybe the likes of AFS or ACBS or Jack Henry, and you have a single source of loans and a single source of securities, this can be implemented in anywhere from a 3 to 6 month cycle. If you have multiple loan systems, multiple sources of data, like multiple, I haven't mentioned deposit systems yet, but that would be one of the integration points. So the more integration required, slightly the longer the implementation of the system. Another question that's come up, what are the pitfalls of introducing a system like this? Well, the pitfalls are there's some complexity to installing a system like this because you need to integrate loan, customer, and brokerage system or sources of collateral. But the benefits, if it's done properly, far outweigh the pitfalls. Again, this is really aimed at organizations that really wish to move forward and to increase their loan book using an approach like this. It's not really aimed at an organization that has no interest in increasing its loan book or already has a small loan book. So with that, I conclude this presentation. I hope it's been of benefit to the audience and to the people who've listened today, and I conclude at this point.
Thanks, Luke. Let me just jump in here. What we've found in the past is that sometimes people post their questions quite late, so we'll just keep the call open for another couple of minutes here if anybody wants to post a question. Otherwise, if people want to drop off, they're free to do so. So this is the kind of the virtual equivalent of coming up to the podium after the presentation. So just I'll just add a couple of comments, things that I noted during Luke's presentation. One obviously is the opportunity cost. So certainly in regarding to market trends, we're seeing that increasingly people are leveraging brokerage accounts to offer non-purpose loans. And clearly, if you aren't doing it, your competitors are. So I guess that's where the opportunity cost really becomes a factor in calculating your ROI and so forth. And the only other item I noted down was concerning triage. So our system features a triage component whereby, particularly in a market dip situation like we've seen at the moment, I know that diagram there we had of the Dow Jones looks pretty flat, but that was a 5-year view. I think we all know that if you look at the market performance over the last sort of 6 months, particularly with the European context as well, what we're seeing is huge fluctuations, and so this can generate an awful lot of out-of-margin alerts, or if you're setting your sensitivity to be alerted when people come within 5% of being out of margin on loan to value, then it generates a huge amount of alerts that need to be processed by a small and limited number of team members. And so the product features a triage capability where you can kind of rank using a kind of a color coding mechanism so that you highlight the most dangerous out-of-margin events, based on the history of the customer and so forth, and react to those first. So it just gives an ability to really focus in on the most urgent matters, and that obviously is helpful in a lot of cases as well. So I don't know. Are we seeing any more questions there, Luke or Mike? I'm not able to see that window.
No, I think that's it. And just as a reminder, we'll be sending you a link to this recording. Thanks once again for attending, and hope you have a good rest of the day. Take care now. Bye.
Thank you.